If you want a clue about where the U.S. labor market is headed, it helps to look at the two economic sectors that still have the most net job losses by far since the start of the recession in December 2007, construction and manufacturing, each of which now has more than 1.5 million fewer workers than back then. Now, in one sense, this is all just part of a longer-term trend. Construction and manufacturing are goods-producing sectors, while the U.S. economy has been increasingly services-based for decades now, and that's unlikely to change. But even so, a look at how these two sectors actually differ reveals something more fundamental about the U.S. labor market generally. Let's look at manufacturing jobs first, the top line in this chart, which has been sloping downwards since the 1980s. During each of the last three recessions, the net jobs lost in manufacturing were permanently displaced. Why? Because of the sector's fast labor productivity growth during those decades. Some economists think that's mostly the result of technological advancement like more automation and robotics, in which case most of the jobs lost might once again be gone forever. But other economists think it's because so many jobs were sent overseas to cheaper wage countries like China, in which case many jobs might return as wages rise in emerging markets. All we know is that over time, the sector has been employing fewer and fewer workers, but the average worker is increasingly better paid. Now look at construction, the bottom line that's gently rising. The sector's had incredibly slow productivity growth for a half-century, which makes its labor market highly pro-cyclical, not only regaining the jobs that were lost during recessions, but also hitting new employment peaks during each subsequent recovery. That hasn't happened yet this time because the housing market remains badly damaged. But given demographic trends, there's no reason the sector can't make a similar jobs recovery this time. What's the takeaway? The manufacturing sector might create more jobs in the short term, but over time it's likely to continue its secular jobs decline, employing fewer but better paid workers even as the sector itself continues to grow. Meanwhile, the construction sector, unless there's a new wave of productivity growth, which is possible, is likely to keep employing more and more workers, but they'll remain poorly paid. And so the difference between these two sectors, one employing very few highly skilled and well-paid individuals, another employing many lower-paid workers, also represents a broader split within the U.S. economy as a whole, and it's one of the reasons that income inequality is so hotly debated right now.